Good day, class. Welcome to Unit Standard 114584. In this unit standard, we will cover financing a new venture, which is comprised of 5 sessions. In this session, we will determine capital requirements of a new venture. Let us start with funding requirements and capital structure. We will briefly look at 10 sources of financing. In order for you to establish a new venture, you need some form of funding in order to purchase the resources you need for your new venture and to be able to maintain all the expenses that come with establishing a new venture. The first source of financing we will look at is owner financing. Quite a number of SMMEs find it difficult to acquire startup financing from a financial or government institution and are then forced to resort to the only source of financing they can rely on, which are personal savings. Having your own money is the best financing option because you do not need to borrow from other institutions, which will charge you interest for the sum you borrow from. Owner financing helps you lower your financial cost. It is important for an entrepreneur to work out a cash flow forecast in advance so that they know whether they will be able to afford continuing with the venture. You should be prepared to invest as much as you can from your own money in order to support your business and grow. The second finance source is friends and family, which is a low-cost and convenient source of funding. You should maintain all transactions strictly business in order to preserve your relationships with other people. The third finance source we will look at is partnerships and joint ventures. If you have a partner who is willing to inject funds into your business, it is logical that you have to repay them in some way, and in practice, if you have a joint venture, then your partner will get stake in the business, and in turn, they have a share in the profits and liabilities of the business. It is crucial to get legal advice when drawing up a partnership agreement so that the interests of all parties are properly protected. With franchises, a joint venture partnership between the franchisor and the franchisee is a financing solution. The fourth finance solution is debt financing, which is acquired from commercial banks, merchant banks, and other financial institutions. The financing solutions offered by these institutes are divided into 2 categories, which is secured and unsecured loans. Under these, there are 3 subcategories: short-term, medium-term, and long-term. Secured loans need you to offer something you own of value as collateral, just in case you fail to pay back the loan. An unsecured loan does not need collateral, but both charge interest. The fifth financing source is private equity or venture capital financing, which is where you sell off shares of your business to private or institutional investors who may or may not participate in the management of the business, depending on the agreement. The decision to invest is based on the business plan you create. As an entrepreneur, you should ensure that it is thorough. The advantage of this financing method is that you do not need to provide security as collateral, but it is difficult to find interested equity investors. The sixth finance source is public equity. It is possible for a company to acquire capital by publicly listing on the JSE. Public equity is generally applicable to large organizations with a great profit history. Apart from the main board listings, there are development capital market and venture capital market sectors that are aimed at smaller developing companies. The seventh finance source is government-sponsored institutions and donor funding. There are a number of NGO donor institutions and government-sponsored institutions that aim to provide finance to small businesses that need capital in order to expand their operations. The eighth finance source is trade credit, where you negotiate scheduling a payment date with your supplier and they give the goods and service you agree to without payment and wait on you to pay on the date you agreed on. There is no interest charges due to the delay in payment. In order for you to be able to negotiate with suppliers, you require to prepare a thorough financial forecast to demonstrate that you can meet their terms. The ninth finance source is factoring or invoice discounting. Factoring is an internal financing option, which is a method of finding cash inside your business before looking for external financing. In this financing method, if you are a supplier of goods, then you can use your debtor's book to free up cash through factoring or invoice discount. In simple terms, you sell your debts to a third party at a discount in return for cash. The 10th and last financing source that we will look at is leasing or hire purchase. This is an expensive financing method, but may be the only option to acquire assets for a business short of funds. Leasing seems logical since income is earned from using an asset instead of just owning it. That concludes the different finance sources. Let us move on to realistic fixed asset requirements for a new venture. Fixed assets are assets that are used by a business for more than a year in order to help generate income for the business, such as office equipment, machinery, tools, land, buildings, vehicles, and so forth. When entrepreneurs start a business, they need to buy fixed assets. The price of the fixed assets has an impact on what you afford to buy. For example, buying reliable second-hand equipment will allow you to use the money saved on other expenses. When you buy fixed assets, you should consider the size of your market. The fixed asset you buy must be able to supply the expected demand from your customers. You have to bear in mind that the value of most fixed assets will depreciate. Therefore, you have to save during the period you use the fixed asset in order to replace it when it is necessary. It is advisable to budget more than the current price just in case there is a price increase on the fixed asset that needs replacement. You also need to take into consideration the maintenance cost of the asset. For example, a car needs to go for services, needs good tires and repairs. Maintenance ensures that the asset lasts longer because you take good care of it. Pre-operating costs are costs you have before even opening your business, such as starting stock, advertising, legal and accounting fees, water and electricity connections, wages for labor done, repairing and improving the building, health inspection fee, and so forth. After you have calculated your pre-operating cost, you need to work out your financial requirements. Decide on whether a loan is necessary, and from there you can start working on an action plan. You need money to take note of your regular operating expenses of your business. Since there are expenses that keep your business running, these expenses are expenses like telephone accounts, electricity accounts, rent, and so forth. It is advisable to calculate the break-even even if your business is making profit so that you are aware of how much worse your business has to do before showing loss. We have come to the end of our session. I recommend that you go over your learner guide so that you can familiarize yourself with all the formulas and terminology used in business. I hope you understood our session. We will continue with the unit standard in the next session.